AMC is now with us on the show. Trideep, afternoon, and thanks so much for joining in. The trend over the last couple of days is that while India is staying afloat and nudging higher, we are underperforming the rest of the peers, particularly in the emerging market, where the valuations are far more comfortable compared to India's premium valuation. What is it that you expect from India from here on?
I think from here on, I would probably think that we'll have a fairly strong heading into the year end overall in terms of absolute terms, because the numbers from the result season have been fairly robust. But on the other side of the new year, I think probably I expect more volatility to come through. That'll be the time when we will debate how deep is the recession, if there is one, or if there is a growth recession in developed markets, as well as the impact of the rate increases coming through on the economy. So a fairly volatile 2 or 3 months coming about. I'm looking at more from the new year standpoint rather than immediately here heading into the year end. And we should brace for that. I think we've had a fairly good year where the first half has been volatile, second half has been fairly strong. The domestic economy continues to be in a very good shape. But I think the first 3 months of the year will tell us how deep some of the fundamental impacts are of the rate hikes that we have seen in the back half of this year.
Trideep, hi, afternoon. We were just talking about campus. I know you can't talk about specific stocks, but any thoughts about the industry, the footwear industry, and because the stocks, to be fair, had seen very large run-ups. The addressable market is very large. I mean, well known. It's nothing new, and the share of high-priced products have been going up. But this quarter for most companies has been tepid. Campus and Relaxo specifically, but even others like Metro, Bata have not done great. Any thoughts here?
Basically, I think the bunch of stocks which are trading at 60 plus multiples, where you find any sort of a ripple coming about on the earnings don't meet the estimates near term, or the outlook is a little bit soft of expectation. I think we are seeing a fairly sharp downward reaction to those names. I think some of the stocks that you sort of mentioned fall into that category. Particularly in a rising interest rate regime, stocks with high valuations are particularly looked at with a fine lens, and any miss in estimates would be actually treated fairly severely. That's what's happening to this space. Also, the exposure to the mass market of the segment that you talked about, which is footwear, is fairly high. And that's one segment which has not done well, is something that we've seen in the last quarter result season as well. Stocks exposed to the urban demand and particularly to the luxury end or the high end have done phenomenally well, whereas the mass demand has been tepid. Also, the rural demand has been tepid. So it's a function of a bit on the multiples where it is, and also the exposure where they sell into.
Hi, Trideep. I recall the last time we chatted, you were pretty optimistic on the domestic place, but I think you were reasonably underweight the IT space. What's your stance now on IT?
I think overall, incrementally, it is over the next 3 to 6 months will be the time to probably reduce the underweight in IT rather than going further underweight in IT. How we'll go through this process depends on the valuations and various different dynamics. But our maximum underweight in IT was around about September, October last year. We've kind of held it stable so far, and as the valuations get more sanguine, we'll be probably looking at it a little more favorably than otherwise as we get towards the first half of next year.
Your financial sector weightage is about 21.5% in the mid-cap fund. Are you comfortable with this, or are you looking to increase it? Because the numbers from across the board in the financial space were very good.
Financials at the moment, in my opinion, is the sweet spot. We are clearly at the early stages of an economic recovery. And in those stages, the early next year is when we will start probably seeing the pickup in lending. We've already seen pickup happening, but that has come on the back of lower base. Next year, we will actually see proper lending happening on the back of capex pickup that will expected to happen in the back half of next year. So the first half might be started with good numbers in terms of loan growth from financial standpoint. So hence, financials are actually a meaningful overweight in our portfolios and continue to remain the same and fairly broad-based. Particularly the lending financials is what I'm referring to, even within financials.
Absolutely. I mean, if you want to look at breakdown the Nifty gains right now with the 78-point move, 30 of those 78 index points of the Nifty are coming from just one name, that is ICICI Bank. So that is quite a heavy contribution coming through from ICICI. 30 out of the 70, 80 points, more or less. And then there is Infosys, which is adding about 8 index points. Bharti and SBI are others with 7 points respectively. So, the contribution is lopsided, but as it always happens, there is something or the other which comes up and shakes up a dull market. It had been a dull market for the bulk of the day, but not any longer. It's got 78, 80 points on the Nifty, which takes us above 18,400 at this point in time. So that's what we are seeing right now. Trideep, where else are you seeing mispricing or opportunities? Because the earnings season is also behind us. In the broader markets and many sectors, there's been a fair bit of upheaval. Earnings, etc., are being revised, I'm assuming mostly downwards, right? For the full year F523. Where are you seeing mispricing?
So I think at the moment, if I were to, in fact, today only I looked at it. If we look at on the back of results, the September quarter result season's earnings have been actually flattish. So we have not seen a downgrade despite all the global headlines that we have actually seen. And the reason why it appears to you the way you mentioned is because clearly the one part of the economy exposed to higher commodity prices last quarter saw earnings downgrade, but there was the other half which benefited from increased commodity prices, and they saw an upgrade. So net, they kind of net each other out. And going forward, it'll probably be the reverse. I think overall, if I were to look at it, in pockets where I'm finding value, some part of financials it still offers value. If you look at whether it's on price to book basis or on a price to earnings basis, after the fact that they've gone through a bad asset cycle and loan growth is just about to pick up, I think there is still some mispricing there, which will hopefully kind of has started correcting itself, will play itself out over the next 6 to 12 months. I think certain areas within building materials where historically there's been disappointment could be an area that one could look at from a going forward basis as areas for mispricing. While the larger industrials are quoting at higher multiples, some of the mid and small cap mid industrials offer good value, still offer good value. So those would be financials, industrials, indirect plays on real estate would be the areas that I would probably kind of still see some value left and positioning accordingly.
Trideep, you're talking about financials, at relatively better valuations. Are you referring to the PSUs?
PSUs have actually offered phenomenal value 2 or 3 months ago. They've unfortunately or fortunately for our investors rallied quite a bit. Yes, they appear optically cheap, but I would incrementally from here on look at tier 2 private sector banks, which are looking fairly decent, if you ask me. Even leading public sector banks and maybe mid-tier private sector banks is where I would say is the hunting ground is, without being more too specific.
All right, Trideep, we'll leave it there. Thank you very much, as always, for being here on the program. Thank you for your time. Well, Trideep Bhattacharya with thoughts on the market, which has moved up even more, 85 points now, so 18,440.